I received a hysterical call from Ron recently. You see, Ron's been trying to get into the market for the last 3 years, and as his mortgage broker, we've been working together during this time. 3 years ago, we helped Ron with understanding his capabilities and budget. He was good to go from a finance perspective. Unfortunately, when the pandemic hit, Rob got caught in the headlines, and understandably so. Economists at the time were predicting the worst. 30% drop in prices, and that might only be the tip of it. So Ron decided to sit tight and see how things panned out. Unfortunately, no one has a crystal ball, and regrettably, the exact opposite happened. Prices in the area that Ron was looking at increased, and boy, did they increase. Properties Ron was looking at pre-pandemic had increased an eye-watering 30%. So now the dust had settled and the market was coming off, Ron had decided to start looking at properties again. And this is where I get his hysterical call. Ron said he'd been reading an article recently where Goldman Sachs had tipped interest rates to hit 7.5% in May 2023. And we're in store for another 5 rate rises over the next 6 months alone. As he said, he was never going to get the chance to get into the market. And if rates hit 7.5% like they predicted, property prices would be almost certain to crash. He is also concerned about his affordability of the mortgage if rates were to go that high. I said, Ron, let's break things down. We'll look at it from a few different angles, gaining a little bit more perspective on what might actually occur. Also reiterated the fact that no one has a crystal ball, and it's difficult to know what's going to happen in the future. Even economists routinely get it wrong, so you're only really going to know when you look back in hindsight. As they say, hindsight's 20/20. And if you find value in this video, remember to click that subscribe button. Ron thanked me and said it'd be great if we could go through some details together. So I said, Ron, let's look at this from 2 different angles. The first is the likelihood of rates hitting 7.5%, and the second is your own individual circumstances. He said, great. I said, all right, let's look at it from the first angle, which is the likelihood that interest rates are going to hit 7.5%. Ron, you mentioned earlier, Goldman Sachs chief economist Andrew Bogue forecasts the Reserve Banks will lift the official cash rate to a peak of 4.1% by May 2023, which would take the average variable rate to 7.5%. He said, that's right. I said, that's an extraordinary amount of tightening in a very short period of time. The impact on mortgage holders would be devastating. And this is where I got my calculator out. We worked out the average variable mortgage rate would soar 56% above their pre-tightening levels, adding another $1,872 per month on a mortgage of $750,000. I said, Ron, think about the average household. Let's say a family of 2 adults, 2 children are both earning $80,000 per year. In that household, the net household monthly income is about $10,000 per month. Mortgage repayments on a $750,000 mortgage, if rates were to hit 7.5%, would be $6,958 per month, which equates to about 70% of that household's income. He said, right. I continued. Add to that, cheap mortgages boomed over the pandemic, with 46% of mortgages taken during that time being a fixed rate mortgage, with it common to get a 2-year fixed rate at the time between 1.89% to 1.99%. These fixed rates are yet to be impacted by the RBA's cumulative rate rises. We know the Reserve Bank has been clear in that they want to get inflation down within the target range of 2 to 3%. These fixed rates certainly haven't helped the Reserve Bank in getting inflation down, due to the fact that these borrowers' budgets haven't been impacted by the Reserve Bank's movements. And the key word here is yet. Many of these fixed rates will expire in 2023 and would reset to more than triple their pandemic level under Goldman's forecast. In turn, many borrowers' household disposable income would be slashed as they'd plunge into extreme mortgage stress. The pending fixed rate mortgage reset means there's already significant monetary tightening in the pipeline, even without further rate hikes from the Reserve Bank. Goldman's forecast would likely crash both the housing market and the economy, plunging Australia into a nasty recession. Ron said, I didn't know that. I continued, Australians who fixed in their mortgages at super low rates are now staring down the barrel of punishing repayments, up to 3 times higher when they invariably roll onto a variable rate. The rate hikes have caught many by surprise, especially as the Reserve Bank governor himself said there was unlikely to be any increases until 2024. However, there was an unusually high number of Australians that locked into fixed rate mortgages over the past 2 years. Fixed rate lending usually makes up to 10 to 15% of the total mortgage market, but the number could quadruple to 40%. Many will roll off their fixed rate terms in 2023, leaving borrowers scrambling to cope with a much higher monthly repayment. There'll be many households that'll struggle to meet repayment. This comes as Aussies are already struggling to keep up with the rising cost of living, with many devoting a bigger share of their budget to essential living expenses. Given these factors, yes, the Reserve Bank could increase the rate like Goldman Sachs is predicting. However, it's unlikely at this stage given the context of fixed rates coming off. Ron agreed. I added, it'll also come down to what happens with inflation. If inflation starts to come down next year, we might see the Reserve Bank sit back or moderate the rate hikes from here, opting to rather see how things play out. But ultimately, anything can happen at the end of the day, as it's dependent on so many different variables. Ron said he appreciated my point of view on this. I asked Ron if he had any questions before we moved on to the second point. He said no. I said, okay, let's talk about your individual circumstances. There are a number of things to think about here. Things like your personal outlook, your budget and affordability, how you structure the mortgage, and having a buffer. Let's start off with talking about your outlook. If you plan to buy a property, then sell it in the short term, say in the next 2 to 5 years, then yes, it's potential that it could be problematic if the market turns. Because as we know, property is cyclical. Having a long-term strategy of buying and holding generally makes the most sense. If this is something short-term, then it's probably not a good idea. Ron interjected and said, Nathan, this is going to be my forever home. I've been renting where I live for the last 7 years, and the next move I make will be the last move. I continued, that's great. So your outlook means that any short-term market corrections will be offset by the long-term outlook of holding the property. Let's move on to your budget and affordability. Right now, you're paying $500 a week in rent. He said, that's right, but they've given me notice that they're going to be increasing my rent by $50 a week when my lease ends in 2 months' time. Plus, I'm saving an additional $200 a week towards my home deposit. I said, okay, you're roughly paying about $2,000 a month towards the rent and say $800 a month towards savings. The total repayments you're used to at the moment is about $2,800 per month. The $2,800 per month you're paying at the moment within your comfort range. He said it was, and even with the $50 increase that's coming through for the rent, he'd still be able to maintain his savings of $200 per week. I continued, Ron, when we did your assessment recently, your borrowing capability was $750,000, and you were only looking at getting a mortgage of about $500,000, which means your lending required is well under your maximum capability. When you do an assessment through a bank, they factor in your ability to repay a mortgage if rates were to go up. Typically, that's 3% on top of the current rates. But they've actually assessed you as if your interest rate was 8%. Also, like we've previously discussed, monthly repayments on a $500,000 mortgage is $2,300 per month as it currently stands. If rates were to get to 7.5%, your mortgage repayments would be about $3,500. Remember, we talked about the low likelihood that rates would get this high. Now, I know you mentioned you're comfortable with repayments at $2,800 per month. However, would you be able to make ends meet if the rate did hit 7.5% and your repayment was $3,500 per month? Ron took a moment to think about it. He said, potentially, it wouldn't be ideal, but he's found his rent has even been increasing consistently of late. He would rather paying off his own mortgage than someone else's. And that's where I jumped in and said, also, don't forget about how we might structure your mortgage. As we've talked about previously, you have an option to look at a fixed rate, a variable rate, or a combination between fixed and variable. That means we can structure your loan to suit your risk tolerance. If you feel like rates are going to go up as per Goldman Sachs forecast, that's where you might fix in 100% of your loan. At the moment, a 2-year fixed rate is coming in at around the 5% mark, which means you can lock the rate in for 2 years. Even if rates hit 7.5%, the loan would be locked in and your repayments would be too, which means you know your monthly repayments for the next 2 years. You've also got to think about when rates peak. We've seen some banks talk about the chance that rates could come back down. And that's where fixing part of your loan and having part of your loan variable allows you to get the best of both worlds, because if rates go up, down, side to side, you sort of hedged both ways. He thanked me for the suggestion and said that he'd give it a bit of food for thought, as it slipped his mind that these options were available. I said the final thing to think about is retaining a buffer of savings post-purchase. Rather than using 100% of your deposit and funds towards a purchase, which would leave you with no cash post-settlement, you might decide to retain $10,000, which would give you a bit of a buffer. This buffer would allow you to weather any unexpected costs or rate movements in the future. We need to weigh up the pros and cons for this. This is something to think about. Plus, whilst you continue to save up your deposit while you're in the property searching phase, the additional savings could be used to retain as a buffer. Ron thanked me again and said he appreciated the advice, and it's given him a different perspective to look at things. Did you know here at Hunter Galloway, we get home loans approved? If you're living in Australia and looking for a great mortgage broker, we can help. Visit us online at huntergalloway.com.au and fill in a contact form, or call us at 1300 088 065, and we'll see you next time.